we're here with Steve Bell from Harding Bell International, and today we're answering some international accounting questions. So we needed a real accountant who could answer for us all these millions of questions that everybody has about buying an investment property in the US, particularly if you live in another country, and what are the steps to follow. So thank you so much, Steve, for coming today and taking the time. And our first question is like, do we need to create an LLC? Do we need to create a company, an entity to represent you in the purchase of a home if you are from another country?
Great. Well, thanks, Maria. It's great to be here. Excited to be here and kind of share some of those things with people. To own an LLC, do you have to have one? The answer is yes and no.
Okay.
And I'm going to talk more from the accountant side versus the LLC side,
right,
versus the attorney side. An attorney many times is going to tell you, yes, you need an LLC for a rental property. But from a tax perspective, generally speaking, you don't need an LLC. It's not going to necessarily help you from saving tax because you pretty much can take the same deductions in an LLC as you can take personally. But there are some advantages, and certainly it really will depend on your situation, where you're at, what your pain tolerance is as far as, you know, money and losing property if something bad should happen. But that's kind of in a short answer, that's it can be a yes and no, really, and it really just depends on your situation, and that's kind of how we deal with clients on that.
Excellent. Another thing I have seen in the past, I have seen clients who own an LLC per each property they own. Right. Why some people would go that route, and do you recommend it?
Well, there's different ways you can set it up. You, for example, could have a holding company own multiple LLCs, and you have those multiple LLCs each own a house. I think, again, it goes to your pain tolerance. Some people can afford to lose 2 houses if you have one in an LLC. Some people can't afford to lose any. Some people could afford to lose 10. We've had clients that have owned 15 properties just in their personal name, which is kind of insane, but you certainly can. It's many times it's best if you're trying to really avoid and contain liability. It can be best to own in one LLC for each property.
So you do recommend it in that case. Excellent. Yes. Now let's talk about saving money in taxes legally, doing it on the correct way. So a lot of people ask me, okay, I traveled to come and see my property from another country. Right. The airfare was $1,500 a piece. Can we write all that off? What is it a common rule of thumb of what it could be taken off on taxes and what could never be written off?
Sure. Well, you can deduct really all of your travel expenses generally if you're the owner of the property. Now, let's say, for example, and this can go for whether you own it individually or you own it in an LLC.
Okay. Because
you're allowed essentially to take flights, car rental. You can also deduct some, hotel, motel if you're not able to stay in your own property. Basically, your travel expenses can be deductible. If you're, say, a married couple and you have children, minor children, you can actually also deduct theirs in certain situations as well, just because they can't stay in their home country by themselves since you as parents are their guardians. So, but you pretty much can deduct all of those kind of things, among many other things in a rental home situation.
Excellent. Another big question I get all the time is, what happens if my expenses overpass the income? Can we do a negative tax return? Could we do negatives for more than 1 year? How does that work?
Yeah, absolutely. A non-resident, or really even a U.S. resident, when they have passive income such as that in a rental property, they can deduct really all those things, from utilities to HOAs to property management fees, when you add depreciation, mortgage interest in, those kind of things then really many times overpass the actual income they have. And so what happens then is that in those losses then will carry over year to year, and they can offset any future gains. And we have clients, of the 3,000 plus clients we have that have rental properties, I would say 95% of them have actual tax losses every year. And so then they can offset those against their income in the future, as well as some future capital gains as well. So it's pretty good stuff if you have a good accountant that handles that for you.
That's phenomenal. Yes. Because who likes to pay taxes, right?
Exactly. So, and it can be scary to some people. They think the U.S. tax system they're going to pay a lot of tax, but when you really break it down, many of them don't really pay much of anything.
Fantastic.
Yeah.
talking about taxes and Airbnb, that's what everybody's into these days. I'm sure maybe a little bit difficult to do taxes when you have Airbnb, but how does it work with those taxes that you have to pay as you're considered kind of a hotel tax, correct?
Right, right. Yeah, especially in Florida, you're going to have sales tax and you're going to have tourist development tax. Generally, the sales tax paid to the county, sales tax paid to the state, tourist development tax paid to the county. Now, what happens now, Airbnb pretty much has made a deal with the state of Florida, so they're paying that for the client. But not in every case are they paying the tourist development tax. So that's something you need to check with your local municipality on. And at the end of the day, the owner of the home is actually the one responsible for that. So yes, you have to make sure that's being paid. And if you're using a property management company that managing your property for you and they're taking bookings, that kind of thing, you just want to make sure that's being paid because, like, again, at the end of the day, you're responsible for.
And is that a quarterly tax? Or?
Those are generally paid monthly. They're paid on a monthly basis, generally speaking.
A question that I always get about the residential part of it, the taxes from the residential part. We know they're usually due in April, correct? April 15th?
Well, for non-U.S. residents, if you have U.S. residents, ours are due April 15th.
Correct.
Non-residents generally are due June 15th.
Oh, okay, very good.
But they can be, both can be extended through like October 15th.
And that's my next question, because I have a lot of friends who actually always push it to that October date. Is it the same to file in June or April or October?
Yes, in some cases. Yes, if you don't owe tax. If you do owe tax, you want to make sure you get an estimate ahead of time of how much tax you're going to owe, because if you don't pay that when the due date comes, then you could pay penalties and interest until that's actually paid. But if you don't owe anything, like for example, in a non-U.S. resident that has a rental property, there's no tax due, they can hold off until October. Now, and it's been said too that the IRS typically sets their audits up for those people that do taxes at the present time when they're actually due, and then those who delay and do them later typically don't get audited. That's what we've heard in the past. So that may change in the future, but it doesn't really matter which time you do it, as long as you're paying your tax on time.
And I know audit, to us, we get, the goosebumps. It's scary for us. I'm sure with 3,000 clients plus, you have seen it many, many, many times. What is it that we should all keep records of? What is important, if we ever, touching wood, it doesn't happen, we get audited?
Well, good record keeping is always important, no matter what your business is, whether you're in a rental home situation or you're a real estate agent, property manager. Good record keeping is certainly important. For people that have businesses here in the U.S. that are U.S. people, one of the red flag things is the home office deduction. That's something that people kind of try and cheat on. You want to make sure you're handling that correctly and not saying that my whole house is my office when it isn't, because the IRS, that is a red flag for them.
Right, excellent.
Yeah.
And what about the 7 years? Is still a rule? We should keep all handwritten receipts and everything
Generally,
for 7
it's good
years?
to keep receipts, whether electronically or, you don't have to necessarily keep paper receipts, but it is good to keep those for that length of time, yes.
Awesome. Well, I'm going to come with a complicated question.
Oh, okay.
So I'm from another country. I own my rental property here. I pay taxes perhaps under an LLC, but by law I have to also pay these taxes in my home country. How does all that work? Because we have to report taxes in the other country from money that was made in the U.S. How all that gets mixed together?
Sure. Yeah, very good question, because many people ask that. They're really concerned about it. And one of the questions I get very similar to that is, well, I paid my tax in my home country, so do I have to pay it here in the U.S.? Well, if you are generating income in the U.S., say in a rental home situation, you are required to file here in the U.S. first. And then of course, you're filing in your home country as well, but any income generated here in the U.S. has to be accounted for. Now, in many situations, we have tax treaties between the different countries, so they're not going to be double taxed. For example, with the UK and Canada and some others, there's no double taxation just because of those tax treaties. some countries there's not a tax treaty, and so then it could be a little more complicated how that's handled.
But in general, if you had paid your taxes in here and you report that gain and those taxes being paid in this country where it was generated, and then whatever is passed to the other country, it would be very rare that you would end up paying double tax.
Right. Well, they could just because of the lack of tax treaties. But those countries that do have the tax treaties, there's no really concern with.
So Canada and UK is very easy.
Those are two of the big ones, and some of the bigger ones. Now, there are other countries we have tax treaties with, but those treaties are pretty complicated, and it's something you really want to talk to a good CPA if you come from one of those other countries, just to make sure, hey, this is what can happen. This is the best way for me to own property, depending on where I'm from.
You know, there's so many CPAs in any country, in every city, and I see the importance of, having somebody like you who specializes on international accounting. Why don't you tell us a little bit more about why it's so important to work with somebody who specializes on rental properties for international people versus anybody else who could want to be helped?
Sure. Well, sure. Well, I think the biggest thing, Maria, is the tax code is very complicated, and for not every CPA, and none of us can say we know everything about tax, just because the IRS tax code is so complicated. So we've specialized kind of anything property related, whether real estate agents, property management, accounting, foreign investors. So, but we have a pretty good grip on those issues, especially the issues for them when they come from another country. So we're very familiar with whether they have, they have a tax treaty with the other country, and so what are the best ways for them to own? So those are the things that are important. If we were big in farming as a CPA firm, then I would say, hey, come to us for your farming stuff. That's not really our area, but certainly we feel like we're very good in that, and it's just because no one can really say they really know everything about the IRS tax code. It is very, and you have certain CPAs that are better in some areas than in others. So.
Fantastic. Yep. What about the way around? Let's say that we are Americans and we own property abroad. What would be the repercussions of owning an investment property in another country?
Great question, Maria. Yeah, as a U.S. resident, you're still required to file, yearly U.S. income tax returns on any foreign derived income. So they're still going to need to claim it here. Now, they may have to claim some of that income in the foreign country if they have that, but they definitely have to claim that here in the U.S. Okay, and it goes add up to your regular income for the year, exactly. Correct? And then based on your bracket, you will get charged on it. Excellent. Well, I think those answers a lot of our clients' questions. Thank you so much for taking the time today to come here and sit with me and answering these questions that sometimes nobody really wants to answer because you need to be a licensed professional like you to be able to talk with clarity. So thank you so much for your time today, Thank you, Maria.
Steve.
It's great being here.
Thank you.